of class, but of course the IRB seminar series has to go further. And I'll talk about that in a second, but this is the last in our series with financial literacy, with the Center for Financial Literacy and IRB, and this is Carolina Reid, who I'll introduce in a minute, and she's the San Francisco Fed, but does a lot of good work, has done a lot of good work on housing and financial stress and so forth. Tomorrow, we're co-hosting a brown bag on the future of disability law and policy, if that floats your boat. And it is right here, and it is at 10 a.m. tomorrow to 11 or 11:30. And it's by Peter Blank, who's a university professor at Syracuse University. He's also giving a talk this afternoon on conceptions of disability, the Wiley Conference Center auditorium at the Wasteman Center. That way, a couple of miles away. Anyway. But then next week, and I have to spread the word among the economists, next week at this time, in this slot, is Bob Pollack from Washington University. And Bob does a lot of work on, it's again the disability folks, and Bob does a lot of really good work on bargaining models, and he's good longitudinal data about who takes care of whom in a household, how the decisions are made, and so forth. So I'm looking forward to seeing him once the disability people say what the topic is. But he's a great speaker. He's more theoretical, but he's empirical too, so it's a great combination. So enough of that. I want to welcome Carolina Reid, and Carolina is from the San Francisco Fed, so we were talking the way up about why people never left the Fed, because they got great jobs and do good research and so forth, as some of Bob's students and Carl's students. She's the manager of the Community Development Department. A couple of the Feds, I know Boston and I guess San Francisco have a stake in their communities and their community groups, so she studies a lot of things to do with the community, including urban environmental health, concentrated poverty, affordable housing, financial well-being, and she got a PhD in human geography from the University of Washington, Seattle, and then moved on to the Fed, I guess. And so Carolina, have at it. You have to set the rules now. You get to go. You go to about 1:30 actually.
Ooh, well,
but
great.
If you want questions, you'll get them. And if you want to run through your stuff first, just wait. I'll leave it to you.
I'm open for questions, so feel free to interrupt, especially if it's clarifying questions. Don't try and get me to say my conclusions at the beginning. I'd rather say those to the end, but feel free to interrupt. I'd love for this to be more informal. So first, I'd like to extend a huge thanks to Michael Collins, who invited me to come today. It's a real pleasure to be here, and I'm excited to present this research. It's an extension of some stuff I've done in California, but now I'm looking national, and it's brand new, hot off the presses. Literally finished the analysis at about 6:30 this morning, so it'll be great to get your feedback and input and ideas as to sort of what I'm saying and if it makes any sense at all. How many of you are familiar with community development at the Federal Reserve? Okay, so this is an unknown function at the Federal Reserve, but every Federal Reserve bank, there's 12 of them plus the Board of Governors, has a community development unit. They tend to be quite small. San Francisco's is the largest because we have the largest district, but we only have 13 people in a building that has about 1,400 staff overall. So we're a really small unit. But the mission of community development is twofold. One is to do research into the issues confronting lower income families and communities. And then the second is to help to facilitate local partnerships that can help to extend credit to low-income communities. So we actually have outreach workers who bring together stakeholders in various communities and try and sort of catalyze collaborations that can do things like create affordable housing, promote small business development. We do a lot of small business technical assistance. We do a lot in the area of capacity building of nonprofits, and helping nonprofits to be able to respond to the issues facing low-income communities. So we have this twofold function of research and outreach. And my job is situated in the middle of that. And particularly, if you're thinking about the foreclosure crisis, if you're thinking about the Federal Reserve's 12th district, the states that we cover include California, Arizona, and Nevada. right? So for the last 3 or 4 years, almost all of my research has been focused on the foreclosure crisis, and almost all of our outreach work has been focused on the foreclosure crisis as well, developing local foreclosure prevention task forces, helping with neighborhood stabilization and property acquisition and that type of thing. So what I'm going to talk to you about today is sort of the research that's coming out of that project, the idea of trying to understand foreclosures, but really trying to understand foreclosures not in a macro sense, but as to what's happening in low-income and minority communities, and how is the foreclosure crisis playing out differently there, and what were the underlying reasons for the disparate impact of foreclosures on these communities. So really sort of zooming down in a smaller lens. So I'm going to start with just a quick overview of the foreclosure crisis. This is what a map of the foreclosure crisis looked like in January of 2007, so right at the start of when we started to see foreclosures rising. You can see, it's a little bit hard to see, but why don't I have a pointer? You can see a little bit of distress here in the sort of, northeast, upper Midwest area. But the rest of the country looks quite good. And actually overall, a sort of normal foreclosure rate is about 1.5%, 1% of mortgages is sort of standard, which sounds really low, but that's sort of a nice normal average. And like I said, we do see a little bit of distress out here. I'm going to skip forward 3 years, December 2010. This is what it looks like today. You can see California, you can see Nevada, this is Las Vegas right here, you can see Arizona, you can see Florida, you can see the crisis intensifying up here. But really what we saw was an explosion in the number of foreclosures, particularly in some of these Sun Belt states that hadn't had any problems with foreclosures previously. So for the first 2 years of the crisis, we have an estimated about 2.5 million foreclosures. One of the really interesting things about the foreclosure crisis is that we actually don't have any good data. So we don't actually know how many properties have gone into foreclosure. Nobody knows. But we're estimating about 2.5 million foreclosures completed, so people really having sort of left their homes. Throughout 2010, we've seen delinquencies drop, which is a really good sign. Through to the beginning of 2010, we saw month-to-month increases in the number of delinquencies. Throughout 2010, we see sort of a steady decline in the number of delinquencies. So those are people who are either 60 or 90 days delinquent on their mortgage. But we estimate that there's probably at least another 5.6 million properties that are imminent risk of foreclosure, in that they're either already in the foreclosure process or they're in some stage of delinquency. So we're not at the tail end of this yet by any means.
So that would really mean that we have triple that number of 2.5 that's what?
If all of these properties actually do end up in foreclosure, yes, we could still see a triple amount. So the question is, so we know that the foreclosure crisis is bad. I think people probably can see it in all the communities here, everywhere else. But what has been the impact on lower income families and minority and communities of color? And we don't know. First of all, because there's absolutely no data. So any data on foreclosures doesn't include any information on the race or the income of the borrower. And any data we have on mortgages that has information on the race and income of the borrower doesn't include any information on sort of the loan type, with one small exception, or information on loan performance, whether or not that loan is delinquent or in the foreclosure process. So a lot of my work has been focused on trying to overcome this barrier and trying to link different data sets together so we get a more complete picture of the whole mortgage process, from origination and the lender that originates the mortgage to the borrower to the loan performance to the final sort of outcome of that loan. So trying to really think of lending almost as a life course, right, and trying to see all the pictures of that. So before I get into the actual data that I use and a little bit, I want to give you just a quick overview. I'm guessing not everybody is familiar with foreclosure and particularly with consumer protection regulations. Is that a fair assumption? So I'm just going to give a quick overview of consumer protection regulations because that matters for sort of the meaning of my talk. So during this time period, so from about 2004 to 2008, we had this incredibly complicated web of consumer protection where every single institution basically was governed by a different set of rules about what kind of loans they could make. So we have institutions that take deposits. They're federally regulated financial institutions. These are your Wells Fargo's, your Bank of America's, any bank that actually sort of has a checking or savings account sort of policy. They're governed by 4 bank regulators. The Federal Reserve is one, Office of the Comptroller of the Currency, Office of Thrift Supervision, and FDIC. So there were 4 separate regulators, and depending on the charter of that financial institution, they had a different regulator. Each of those regulators imposed a different set of regulations and requirements on its member banks. So already, even among federally depository institutions, you have 4 different regulating institutions with very different cultures and very different rules and different requirements as to how their member banks should behave. Then we had this layer of state anti-predatory lending laws, which was really uneven. So we had about 28 states pre-2004 that enacted coverage of state anti-predatory lending laws. These are 28 states that went beyond the federal HOPA statute, which was sort of the overall federal law governing mortgage regulations. Independent mortgage companies, so those are companies that only did mortgages but don't take deposits, right? So they're not regulated by these Fed regulators because they're not depositories. They are subject to state laws. So they weren't subject to this set of sort of examination and regulation, but they were subject to this set. But their books are not examined. There was no way to enforce those laws unless there was a consumer complaint enacted upon them. So enforcement of these state anti-predatory lending laws was actually quite weak, especially for independent mortgage companies. Then in 2004, the Office of the Comptroller of the Currency here preempted all of its member banks from state laws. So if you were a bank and OCC was your lender, even if you were operating in a state with stricter state anti-predatory lending laws, you weren't subject to those laws. You were only subject to the OCC laws. Office of Thrift Supervision made that change in 1996. So the point here is that basically there's one product, right, a mortgage product. But depending on what door you went into, you were covered by a very different set of consumer protection standards. It's sort of like thinking, if you think about the restaurant industry, like that Chinese restaurants would somehow be regulated differently from Indian restaurants, from, you know, Mexican restaurants. Basically, you know, all of them serve food, but it didn't matter. It was all different. So we add upon that the Community Reinvestment Act, which was designed to ensure that banks provide the credit needs to all communities, including low-income communities. So this was an additional layer of regulation or sort of legislation that requires that all banks meet all credit needs so that they couldn't unfairly discriminate certain borrowers based on income or race. And actually it's just income. Race is not part of the Community Reinvestment Act statute. Banking agencies assess the record of an institution. This only applies to federally regulated institutions. This only applies to that first set of banking institutions. It doesn't apply to independent mortgage companies. But if you take deposits, you're subject to the CRA, and any loans that you make within your assessment area, which is where you have a branch, usually the MSA in which you have a branch, these loans are scrutinized under CRA. So there's examiners that go in and actually look at your loans and see to what extent are you actually doing good loans in this area. CRA does not apply, like I said, to independent mortgage companies, and it also doesn't apply as strictly to banks who lend outside of their assessment area. So if you have a branch in Madison, but you're making your loans in Milwaukee, your loans in Milwaukee will not be as closely scrutinized as your loans in Madison unless you have a branch in Milwaukee. If you have an affiliate, so if you, for example, have Countrywide as an affiliate of your bank, Countrywide is not assessed as part of your CRA. So the CRA is actually shaping a very small portion of different banks' activities. All right. So CRA, I don't know how many of you have heard, a lot of people are blaming the CRA for causing the subprime crisis by forcing banks to lend to lower income communities. That's patently false. I'll show some data on that going forward. But what's really important to note is that really CRA actually covers a very small part of the market overall, right? Particularly during the subprime lending boom. A lot of the mortgages were made by independent mortgage companies that have no CRA requirements whatsoever. Okay, So, what have I done? Data. Any other questions sort of on the regulation stuff before I go to the actual stuff?
It's sort of like a historical question. When the Community Reinvestment Act went into being, was there discussion, concern that the mortgage industry was being left out of this? I don't remember.
So when the Community Reinvestment Act was established in 1977, and there were no independent mortgage companies. So
They never were added in.
they didn't, and the concern, the driving factor for the CRA was that there were these banks in these communities that were taking deposits from the residents, but that they were not lending to those residents, right? So somebody in a bank in Chicago would take residents from the south side of Chicago, take deposits, but then would only lend to the suburban sort of residents in suburbs. And so the idea was that if you're taking deposits from this local community, you should also be required to lend in that community. And that's where this idea of an assessment area came about. But there's a lot of reasons to think that we need to modernize the CRA, right, and rethink how the CRA is structured, given all these changes in the mortgage banking industry and in the financial sector. And there's some really good papers on that. If anybody's interested, I can point you to a volume that has, I think, maybe 18 different contributions from different authors on all the ways that the CRA should be modernized.
Did they, in the last 10 years, have they weakened the CRAs? I seem to remember, John Hinger was my colleague, and he writes a lot on this, and that they had weakened the CRAs.
So the CRA actually was strengthened in that in 1995. In 2004, the OTS broke away from the other regulators and changed the requirements under CRA and weakened the CRA for OTS regulated banks. And then in 2008, the OTS came back. So now all the banks are actually, or all the regulators are back in line on the CRA. I think the bigger problem about the CRA is that it hasn't kept up with changes in the financial industry, right? It's a regulation that was written too long ago to actually have much relevance. Though, as I'll talk about later, we actually see some really good things coming out of the CRA and out of loans made by banks covered by the CRA in those assessment areas where they actually really sort of had to pay attention to the loans. Okay, so what did we do with my colleague Elizabeth Latterman early on, about 2 years ago? We figured out that we could actually, like I said, reconstruct sort of this life of the loan, link data from the Home Mortgage Disclosure Act, which has information on the borrower's income and race, with information on loan performance, which is information about the mortgage, the kind of mortgage that it is, whether it's an adjustable rate mortgage, whether it has a balloon payment, all those sort of things, which includes information on the borrower's FICO score, which has been a huge drawback to HMDA data, in that the HMDA data doesn't include any information on the borrower's FICO score, and then being able to see the delinquency. So we matched those two data sets together. We also matched data on the information about the lending organization. So who actually made the loan and what was the regulatory structure that they were under. So we have the lender and their regulatory structure. We have the borrower and information about the borrower. We have information about the loan and what type of loan it was. And then we have information on whether or not it's gone 60 days delinquent, 90 days delinquent, or in foreclosure. We also add a bunch of neighborhood characteristics. We merge in data from the census on percent minority residents. We merge in data from the Bureau of Labor Statistics on unemployment. We merge in data on house price changes at both the zip code and MSA level. So now we have a sort of a complete picture that we can start to analyze. What I'm going to present today is a panel data set of about 500,000 loans that were from the largest 50 MSAs. So until this paper, we've only ever done work on California loans. We started in California. But this is largest 50 MSAs. They're loans that were originated in 2005, and we track their monthly performance all the way through December 2010. So this is going to tell us something about what happened, not everything. So I've also appended sort of a qualitative analysis to this. I really want to understand how borrowers chose what mortgage lender to go to. And Michael's seen a little bit of this. I think Nicole might have seen a little bit of this last year, but this is work I'm doing where I'm interviewing homeowners in Stockton and in Oakland. These are the two sort of faces of the foreclosure crisis. Oakland is a sort of a minority, older neighborhood, lower income neighborhood. Stockton is what you can think of as a boom burb, lots of construction during this time period, all sort of 3-4 bedroom big houses, all that look the same. I've done 112 interviews. I've coded 80 interviews so far. They're all in-depth, unstructured interviews, and they're specifically focused on trying to understand mortgage choice and borrower decisions to enter homeownership and what kind of mortgage to obtain. So I haven't asked them any questions about what's happened post-foreclosure. Not everybody in my sample is actually in foreclosure, but it's all about that sort of initial decision to take out a mortgage. The sample includes both delinquent homeowners and homeowners who are current on their mortgage. I want to sort of understand the differences between those two, where there are different patterns that we can see about people who are in distress versus those who are not. And I'm using what I call a block recruitment strategy. So this is Oakland. Areas in red are the areas that have a lot of foreclosure. The green sort of highlight around it are low-income and moderate-income areas. What I do is I go to borrower outreach fairs. These are fairs that are designed to help borrowers who are trying to prevent foreclosure. They get connected to a counselor, and then the counselor helps them work with the servicer to get a loan modification. And I ask them to interview somebody there, and then I ask them for their property address. Once I have their property address, I go down to the neighborhood, and I go to the block where their house is. Oops, there. And then what I do is I canvass the rest of the block. And I ask every neighbor on that block to see if they would be willing to do an interview. So then I can interview the neighbor 3 doors down and learn about their experiences on the corner. And I learned that all 3 of those got their mortgage loan from the broker who they all met at their neighborhood church. Right? So the idea is that there's something about social context and social process that really matters in the mortgage market decision, and by understanding sort of what neighborhood processes were affecting people who are in the same neighborhood and hopefully in the same social context, that they might have been influenced in the same way. So that's how I find my sample. I do the same sort of pattern for Stockton as I do for Oakland. So what are the research questions? So within this patchwork of regulation and efforts to extend credit to all communities, how did lower income and minority borrowers fare? So this is basics. Yeah, see.
That seems to imply that instead of people wanting to buy a house and then seeking to go about that process, they meet the broker first. Is that true?
So it's in tandem. And I might have misspoken, right? That's not the idea. The idea is that people want to buy a house and then they make a choice about what they do for their mortgage. But in some cases, those are actually in tandem, as I'll talk about in a little bit. How do mortgage market channels and the regulation governing those channels influence borrower outcomes? So by mortgage market channel, I just mean who did you get your loan from? What kind of institution were you? Did you go to a mortgage broker? That type of thing. What mortgage product did a borrower receive? Did we see a disproportionate impact if you went to one lending institution, you got a worse loan product than from another institution? And how do these factors influence the likelihood of ending up in foreclosure? So did this matter in terms of bad outcomes for borrowers? And finally, sort of what were the factors that influenced the choice of mortgage lender and mortgage product? So here's the first slide. This is just looking at the rate of foreclosure by race. But you can see this is the white. So what we can see is even early on, 2007, 2008, Hispanics and blacks were disproportionately affected by the foreclosure crisis. They have a much higher rate of foreclosure. Starting about 2008, 2009, we see, particularly among Hispanics, a huge spike in foreclosures. In whites, we see actually quite a low level of foreclosure until about 2009.
In terms of do you know, so on Hispanic, do you know how many people are there people in there basically who are not here with documents, or would that be nearly impossible to do, except, I was just wondering, because things were so crazy there at the end, could you end up with a mortgage even if you were undocumented here?
You could have ended up with a mortgage even if you were undocumented.
Okay.
In all of my interviews, I haven't found a single person for that to be the case.
Okay.
I think that that's relatively rare. And I think partly, I mean, it depends, this is harder, right, because this is national, but in California, the price of getting into a home was so large, right? I mean, we're talking about, in Stockton even, sort of an average house price of about $500,000, that most undocumented immigrants wouldn't necessarily have the resources to be able to do something like that. These were people that have put down roots, have established sort of job connections, are making a pretty decent salary. So I'm sure it's there, but I think it might be at the margins. It'd be great to figure out how to study that more, but I don't know how to do it. For income, we see a slightly different picture. At the start of the crisis, we see actually that moderate income families are hardest hit. And I'm defining low and mod by relationship to their MSA income. So low income is at 50% of MSA, mod is at 80% of MSA, and then middle is at under 120% of MSA, and upper is above 120 of MSA in terms of household income. We see that moderate income families are sort of harder hit until about this 2009 sort of, again, inflection point where we suddenly see middle and upper income families being hit harder. So one thing that's going on here, so how do we explain these trends? One thing that's going on is unemployment, right, and the effects of the recession. And we can see that actually very strongly when we sort of regress a variety of measures, and this is at the MSA level. But this is 2009, third quarter 2009. This is the relationship of unemployment to the likelihood of being delinquent during foreclosure. And what you see is that it really starts to increase in that third quarter of 2009. It plays much greater influence on the likelihood of sort of high foreclosure rates at the MSA level. This other line is house price changes. This means that if house prices go up, how much does the likelihood go down? And what you can see is there is a strong relationship between house price change as well, right? Like if house prices are going down quickly, you're going to see a lot more foreclosures than if house prices are going up. But we definitely see sort of an unemployment effect. And we see it also strongly for the different racial groups, racial and ethnic groups, right? So we see a much higher unemployment rate for blacks and Hispanics. So you can see that the recession is extending the foreclosure crisis to a higher range of, or larger range of income households, but there are certain ways that black and Hispanic households are still more vulnerable and still more likely to lose their home, which explains that we don't actually see their declines at all in the slope in terms of foreclosures. So what else is going on? Well, why are minority and lower income families, particularly minority families, more affected by the foreclosure crisis? One thing that's going on is differences in credit scores and credit profiles. This is a graph which shows you whether or not someone is a subprime or prime credit score, has a subprime or prime. Subprime being defined here as a FICO score of less than 680. And what we can see, so this is white low income and moderate income households, and middle and high income households, low and moderate income blacks, middle and high income blacks. What you can see is particularly for blacks and Hispanics, even at the high income, we see quite a lot of people with subprime credit scores and a lot of subprime borrowers, right? If you look at whites and Asians, you can see that among low income, you see a higher proportion that have subprime scores compared to high, but actually not all that much. But really here it's pretty flat. And so there is a real difference in credit scores among these different borrowers, and there is a very strong relationship between somebody's credit score and the likelihood of foreclosure. There is, it is a strong relationship.
So is the relationship between low credit scores and income stronger than race, or is race the factor the dominant here?
Race is a dominant factor. Turns out for almost all this stuff, race is always dominant over income. And one challenge we have in terms of trying to tease out the effects on the foreclosure is that we have income at origination. We don't have income at foreclosure. So if they've had an income shock, you wouldn't actually see that in the data.
The literature on social determinants of health looks at this somewhat and talks about it in terms of intergenerational transfer of wealth, where some communities of color haven't yet built up that kind of reserve. So
That's right.
That's why their credit scores are also lower.
So there's some really cool stuff coming out on credit scores now. One thing that we are finding is that when youth sort of leave the nest, so to speak, almost universally for every racial and ethnic group, credit scores go down. So basically when you're 20, you make a really stupid credit card decision, right? You buy too much. What we see is we see them all go down, and then we see for white children or white youth, we see their credit scores go quickly back up, back into the prime, and stay prime. For African Americans and Latinos, we see it stays flat. They stay stuck in that subprime category over the sort of next 10 years of their life. And I think a lot might actually have to do with intergenerational wealth transfer, right? If you're coming from a family that can say, okay, you did a stupid mistake, I'm going to pay off your credit card bill, you can pay me back through your allowance over the next 10 years, right? There's probably lots of things going on there, but it means that there are certain groups of people who are sort of relegated to this subprime market, which then has untold sort of costs going forward in terms of their access to mortgage credit, college credit, all these other things. And I think we need to understand those dynamics a lot better.
Do you have any concerns about the income reports here? I know in the media there's a lot of talk about, no paperwork or no documentation loans and people making up, whatever their income is. And that's where this income information is coming from, right?
It is. So yes, that's another factor that weakens the strength or the importance of that income variable. No, definitely.
Well, no doc, you wouldn't know the income. So it would be missing.
It would be missing.
So people may lie.
Right. So you get rid of the missings, but the people who overstated it. So that means these figures are biased
So
upward.
that's actually a really interesting question, because if you look at the loans, you can have no doc, but you can have income reported in HMDA.
They just literally make it up.
They must literally just make it up. So anyway, so there's definitely a credit score, a credit story here. But, and this is what I'm most interested in, there's also a mortgage market channel story, and the fact that these institutions weren't evenly regulated. So this is, again, sort of white, black, Hispanic, and Asian. If you went to a mortgage broker, or if an African American went to a mortgage broker, 54% of them received a high-cost loan. So they received a subprime loan, meaning that they were paying more for that loan, and then it had sort of other features, often other features embedded within it. In contrast, if they went into the actual retail branch of a bank, it drops to about 10%. For whites and Asians, we don't see that same huge effect of going through sort of a different door. Similarly, if they went and got their loan from an independent mortgage company as opposed to one of these federally regulated financial institutions, about 58 to 60% of them received a subprime loan. Whereas if they went to a federally regulated bank, we see that those proportions are much, much lower. Now you can say, okay, this is because people with different credit profiles are going to these different institutions. Well, it's actually not true. We can, well, I mean, it could still be true, but we can put in a model where we control for all that variation. We can put in their FICO score, we can put in their loan to value, we can put in their income, we can put in all those things that sort of matter for the underwriting decision. And if we do that model, and this is now reporting the marginal effects of these different institution channels, we still see this huge effect. So if an African American or a Latino went to an independent mortgage company, after controlling for all the other variables, they were still about 18% more likely to get a subprime loan than if they had gone to a retail branch. If they had gone through a wholesale broker, it's about 17%. And the effect is stronger for African Americans than Hispanics. If, in contrast, they went to a lender within its assessment area, so they went to a federally regulated institution, and that institution had a branch in that neighborhood, there was a huge protective effect. They're about 16.9% less likely to get a subprime loan, even controlling for their credit score, their income, their loan amount, and all these other things. So we definitely see effect here of that mortgage market channel on borrower outcomes.
Somehow the independent mortgages and the wholesale brokers, they just going to push the paper and sell it to my pension fund, or your pension fund, and so forth. So they don't have any stake. Whereas the banks have a different, have more of a tie and a bigger stake in the loans. Is that true?
That is definitely true. So that's part of it. Part of it is, I think, in the CRA assessment area, this is where banks have a lot more information about the borrowers, about the neighborhood. They're likely to work with nonprofits in those neighborhoods to try and sort of meet their CRA obligations. So they might actually be getting borrowers through housing counseling programs where the borrowers are better prepared. There's lots of things going on here that we don't necessarily understand, but it definitely shows that when you sort of have this kind of web of consumer protection that doesn't treat all institutions similarly, people fall through in very sort of deleterious ways. So just to give you some context, This effect is about the same as if we raised those people's credit scores by about 100 points. So it's not a small effect, right? Like it actually really did influence the sort of mortgage product outcome.
What is the distribution of loans across these 4 types?
So I haven't looked at it for these data. In California, about 40% of loans on average were made by independent mortgage companies, and about 50% of loans were made by mortgage brokers. And that's probably pretty true across the United
And
States.
10% are CRA. Right?
Yeah. I think it's a little bit more. I think it's like 14% or something like that. So these two are not mutually exclusive. You could have a wholesale broker origination who would then sell that loan to an independent mortgage company. They're not necessarily mutually exclusive.
Is it reasonable to think then that, particularly for these folks who have these high-cost loans, that foreclosures are good things in the sense that they're able to get out of these contracts that they sort of unwittingly got in, valued their house fell, and so they're able to get out in a way rather than to be under the thumb of what clearly is a bad debt contract? Or are these all kind of, in your view, unambiguously bad, that foreclosure is a bad?
I wouldn't say that there is unambiguously bad. I think the biggest question, and this is one answer we don't actually know yet, are what are the long-term consequences of that foreclosure? If they can get out of this bad mortgage contract without much impact on either their mobility, their housing situation, their labor market condition, their kids aren't necessarily disrupted from their schools, then in some cases, yeah, it's probably a good idea to get out. And I mean, some people are making that active choice, right? This is what we're talking about, like sort of the strategic defaults, people sort of choosing this is not making sense to pay this anymore. I think particularly in this early period, I think there were a lot of families who really didn't understand their mortgage terms and who really wanted to stay in these homes, right? Who were really purchasing home ownership to become a homeowner, and who would have been better served by getting a loan modification that brought, or in the first instance, getting a loan that better matched their FICO score and their own risk profile.
Do you have any idea how many people who go through foreclosure then end up owning a home in the next year or two? Is it tiny or is there a reasonable number? You know?
So we don't really know.
That'd be interesting.
It would be very interesting. I think maybe some of the credit score data is going to allow people to be able to do this kind of thing.
Just a really basic question. Could you give some examples of these 3 types that might be recognizable to you not knowing much about this?
Sure. So a mortgage broker is somebody who is basically like a middleman. So you would go to a mortgage broker and you would lay out your sort of income profile and your asset profile, and you would say, I want a loan for $400,000. What they have is they have a bunch of rate sheets from the banks that say, if you have somebody with this kind of sort of risk profile, you can offer them this kind of loan at this price. And then the broker will say, okay, this is the loan that you should take. And then they sort of fill out the paperwork for you, but the loan is actually made by the bank that they've used the rate sheet for. Now, there was a really pernicious problem during this time period where if you were a mortgage broker and you got somebody into a more expensive loan than they actually qualified for on the rate sheet, they actually received a bonus incentive payment called a yield spread premium. So it was actually in the broker's best interest to get you into a more expensive loan, because then they were able to sort of get a kickback from the banks for that. So, you know, there's a problem there. So the independent mortgage companies, they've now been banned, right? Yield spread premiums have been banned as part of, I think, Dodd-Frank. The independent mortgage companies are like the AmeriQuest. So these are companies that really didn't have any bank presence. They were just lending for mortgages, and they were all being sort of funded through the big Wall Street firms and banks and securities and that kind of thing. It is very instructive that I think the 180 more independent mortgage companies that were operating during this time period, I think maybe only 3 are still in business. I think they've all gone bankrupt. So, does that help?
So this is a sort of related question to that. You've presented this like it depends on which door you come in, but don't people go in one door and get rejected and then go in a different door? Is that common?
So we've tried to test for that, and I'll get to that a little bit in the qualitative interviews. There's no evidence of that, and even if we control for like hum to denial rates at the local level, we don't see like neighborhoods that had a lot of denial rates from federally regulated banks, that we see more mortgage originations from independent mortgage companies in those areas. What it turns out, not, like I said, I'll get to this, is that people don't really actually shop around for a mortgage, right? During this time, people were so eager to get into a home that they got a mortgage quote and they went with it. They weren't willing to sort of say, oh no, maybe I'll shop around.
Well, that means it's important to know how many people are, as Carl was saying, they want a home for themselves. And how many people were taking interest only, or essentially we're going to roll the house. We're going to thought if I borrowed here, it's up 50,000 next year, and I sell them, I'll live off the difference. Do you have any idea how much of that? No idea. I'd be interested. You probably should be able to tell who buys and sells homes frequently. You know?
Yeah, I don't know how.
Yeah, could you give a little background as to the tie between being in foreclosure and declaring personal bankruptcy? Do most people who enter foreclosure then declare personal bankruptcy?
I don't know, but I think the answer to that is no.
No.
No. It's more likely that somebody will declare bankruptcy first, right? Because then it protects their home. Their home is protected under bankruptcy. I think they're not necessarily, what is it, like 1% of our foreclosures were also in bankruptcy? Yeah, I don't think it's very common.
So in bankruptcy means you've applied, or does it mean you are declared?
I'm looking at Michael, this is not my area of expertise.
You only have to apply to get the automatic stay.
You file.
Yeah, once you file, that gives you like the protection against creditors and all.
But the foreclosure process is just forestalled, it's not stopped.
Well, the reason for my asking is that is if you do declare personal bankruptcy, that does have implications for Carl's question, namely your ability to, again, buy a home in the short term.
That's right.
I can't imagine though, if you go into foreclosure, could you really get a home loan after that, a year later? I don't know. But anyway, the question I had was actually about those, and if you're going to get to this later, that's fine. But the difference between Black and Hispanic, so the first slide you showed us was the foreclosure rates. I mean, it was markedly higher for Hispanics. But every slide you've shown us since then has either showed African Americans in a worse place or they're comparable. Do you have a sense about what's going on there?
So I think it's all the different drivers of foreclosure, right? Like I think for the African American community, particularly in the earlier part of the crisis, it was very much driven by subprime lending being targeted in those communities. I think for the Hispanics, the reason we see such a high foreclosure rate is that most of the industries that they work in have also been really hard hit by unemployment. So you think about the construction industry, the housing industry. These are all, I mean, in California, I think, so the Central Valley, which is one of the areas that have been hardest hit by foreclosure and is probably a little bit overrepresented in these data, the unemployment rate in those communities is like 28% right now. And it's largely for Hispanic families. So I think it's sort of layering of multiple vulnerabilities. So not any one of these things is the sole contributor to the foreclosure crisis. And I think if you layer those vulnerabilities, you get a worse outcome.
So even though there's some interactive effect maybe going on, that you can't see.
Exactly.
So somebody made a comment about being turned away and then going to a different channel. I mean, does everybody actually have access to these 4 avenues? Like, because it seems like that could be a big part of the story.
So one thing I tested in the quantitative analysis was, is it just that certain institutions are located in certain neighborhoods, right? Like you always hear that check cashers and payday lenders are concentrated in low-income neighborhoods and not in the high-income neighborhoods, and then there's no banks in the low-income neighborhoods. We didn't see any locational effect of these institutions. So they're all in the same place. But I'm going to get to the social processes of why some people choose one over the other, and I think that those are really important. So just quickly,
Well, I'll say one thing you might want to test at some point is if there's any market competition effect. So maybe there's some market you did.
We tried the Herfindahl-Hirschman index, and
Nothing.
It's not even significant. Nothing. So we then did a computing risk models for performance to figure out whether this mortgage market channel matters for performance. So not only in terms of what kind of product do you get, but does it matter also for the outcome? And what we find, so this is, and I'm just going to breeze through this quickly because I think people might be interested in the qualitative results, is one thing we find is that all the factors that matter for foreclosure that we think would matter. So if you had a high cost loan, you're more likely to be in foreclosure. If you have a high loan to value, you're more likely to be in foreclosure. If you've seen rapid house price depreciation in your MSA, you're more likely to be in foreclosure. Low FICO, you're more likely. If you had an ARM or a no-doc loan, you're more likely to be in foreclosure. Race is also significant in predicting default, so the race effect doesn't go away. Blacks and Hispanics are more likely to be in foreclosure. So the weird thing is, with the importance of unemployment, we can't actually pick it up in the loan level models. So it's really significant at the MSA level, but when you're actually looking at the, and I think part of the problem is that we only have unemployment at the MSA or at the county level, right? But you don't actually see it as having any effect on the model itself for the loan level performance. And be interested at the end to hear if you guys have other ideas of how to isolate that unemployment effect in the models for individuals.
Are they trying to isolate the unemployment effect or the recession effect? I mean, these people have bad loans. A lot of this might have happened if everything else was steady state, right? Or they got into a balloon loan or something. And that's compared to what the extra add-on to the recession was for. And unemployment is your proxy for it.
Yes. So that's, I'd like to be able to tease that out, right? And right now I'm not having any luck with it. Income, again, it's not a problem. I think this is a little bit the idea that maybe our measure of income isn't that great, especially if people lied on their income form, and also because it's measured at origination as opposed to contemporaneous with the foreclosure. So here's where it gets really interesting. So mortgage market channel, so these ideas of where you got your loan from, they matter a lot for performance in 2008, and they especially matter in boom states like California, Arizona, and Nevada. But by 2010, the effect of that mortgage market channel disappears. So it's not influencing performance anymore. And I think that that's sort of, again, trying to tease out, this is why I want to tease out, I think this is the recession. Like, I think we're looking at a two-tiered foreclosure crisis. And that what was driving those foreclosures in 2007, 2008, and early 2009 are very different from the ones that are being driven now. And to try and understand that seems really important to me. Okay, so here we go. So the big question is, so why did these people go to independent mortgage companies, right? Like, why didn't they go to the retail lender? And so what I'm going to argue is that getting a mortgage it's an economic decision, but it's as much of an economic decision embedded in social processes than sort of a rational economic decision. And I used Granovetter's notice of social embeddedness to sort of understand it. One is that social networks and where we are, where we live, influences the information we receive. And he talks about strong and weak ties for that, and the different kinds of information that go through those two different routes. Social norms and the stories we tell, again, the social context that we're in, also shape the motives that drives people economic actions. And the third thing that I think resonates really well from the interviews is that social context influences perceptions of trust and the idea that somebody is going to do the right thing by you. And I hear this a lot in the interviews, right? People wanted to go get their mortgage from somebody who was going to do the right thing, and they had very different ideas about who that person would be than what we would see in looking at my quantitative data. So here's one example. So now this was a very common ad in California during this time period. A $400,000 loan for just $1,287 a month. I don't know if any of you have shopped for a mortgage recently, but that's not what it costs. So people had really bad information during this time period, especially people in these communities that had high rates of subprime lending. They were embarrassed to talk about their loan products with people in their office or outside of their close social networks. There was a lot of expression of, this is private, this is my information, I'm not going to share this information about a loan with me. If they had, they wouldn't have found very many people that could have given them the idea that this wasn't an appropriate loan, that this was not a sustainable loan. Out of the 80 people interviews I conducted, only 6 of those respondents had a 30-year fixed loan. Everybody else had some kind of exotic loan product with weird pricing structures. And that was the norm. I mean, I had somebody literally in the interview tell me that they had a 13% interest on their loan. And she said, it's so much better than my credit card, right? And it was, her credit card was at 18%. And so it was a very legitimate sort of, rational explanation that she didn't think that that 13% loan was too much. So lots of sort of missing information. I think one of the innovations that the board is doing now on disclosures is that when you apply for a mortgage, it's going to show you the average of price interest rate that you would get if you had shopped like at other places. So you can immediately sort of see, oh wait, 18 or 13% isn't a normal cost of a loan, right?
Are these all new loans or are they second loans? And can you tell who's trying to essentially pull capital out of their,
So these are all purchase loans.
all original ones?
Yes.
See, the second, in that story the woman told could, could very well deal with the second mortgage.
Yes.
It'd be very rational there.
The other thing was social norms and expectations, and I think that this is really important going forward. Remember, these are interviews in California, right? It probably plays out very different in Madison. But in California, everybody was talking about getting into homeownership. There was a real sort of social push that if you didn't get into homeownership now, you were never going to get into homeownership. And basically, you should do it at all costs. And it didn't matter because house prices always go up. Prices don't go down in California, right? That was over and over again. Didn't think anything bad was going to happen. I just kept thinking that if I had bought in 2003, I would have doubled my money. My neighbor did. I didn't want to miss out, right? There was that idea of, I need to get onto this now or else I'm going to lose out. With house prices going up the way they were, we felt pretty confident we'd be in better financial shape in a couple of years. Nobody was thinking about what are the consequences if house prices go down. Nobody was taking that extra analytical step. And then finally, trust and social identity becomes really, really important in the interviews. In Stockton, and this goes to your point, in Stockton what happened was there were houses for sale, newly built homes. The builders would put mortgage brokers in those houses waiting for the borrowers to come in. You would come in, you would see the house, and they would come up to you and they'd say, would you like to be in that house? Would you like to live in this house? And the homeowner would, or the borrower would be like, oh yeah, this is a nice house. Well, let's sit down. Let me see if I can make this happen for you, right? And amazingly, they knew who they were targeting. They knew that they were targeting recent immigrants. They knew that they were targeting Hispanic and a lot of South Indian families. And that's who they put in those homes. So the broker was inevitably Hispanic for the neighborhoods that were predominantly Hispanic and inevitably Indian for the neighborhoods that were predominantly attracting Indian borrowers. So the brokers themselves and the developers were capitalizing on this idea that if it's somebody that you trust, that's speaking your language, that makes you feel comfortable in that home, makes you want to buy the home, makes you also believe that that mortgage is going to be the right thing for you, right? In the African American communities in Oakland, there was a really different dynamic. There was, in the interviews, there's incredible distrust of the Wells Fargo and the Bank of America and these other banks that we would, in the data, show actually led to a better deal. Because these were the banks that completely redlined these communities 30 years ago. And so, oh, I'm not going to go to that bank. That bank denied my dad a loan, 20 years ago. So I'd rather go to the broker that's in my community that goes to my church because I trust him. I trust him to do right by me, right? So these social processes influenced how people made decisions about their mortgage, and that really shaped how they sort of made their choices. And to show you the implications of that, this is sort of a thingy. Only about 10% of the people I've interviewed read all the documents. Actually, only about 20% read some of the documents. Now, in California, over this time period, you can conduct the entire real estate transaction in Spanish or in another language, but the documents were only in English. There was no requirement to have the documents in Spanish. So there was no way for some borrowers to actually even assess whether or not those documentation was what they talked about. Almost nobody had someone else other than the broker read the documents. There was incredible trust that this broker was going to do and make you sort of the right decision, whereas we now know the broker actually had an incentive to not give you the best loan, right? But that wasn't sort of the understanding. Interestingly, several of my interviews have been with mortgage brokers because they were also, a lot of people, got into the mortgage broker industry during this time period. It was a good job during this time period. And very few of them did it intentionally, or the ones I've interviewed didn't do it intentionally. They didn't understand the ramifications either, right? They had the rate sheet. they were getting somebody into that rate sheet. They thought, oh, well, I'm going to up it by 10%. I get to make some money, right? If you're running a retail store, you also up your sandwich cost by 10%. You're allowed to make a little bit of profit. There wasn't that next step thinking of what are the implications of this loan for this borrower. And they actually thought they were doing these borrowers a favor. They were getting them into the home that they wanted, that they might never could have gotten any other way. So only 10% of borrowers shopped for more than one mortgage quote. Almost everybody took the first mortgage quote that they got. Once they were told that they were approved for a mortgage, they didn't look any further. They didn't do any more research on it. Here we see a vast majority of the people who used a broker, it was of the same racial or ethnic background. So this was also interesting. About 40% of the people I interviewed knew that the broker stretched the truth on the loan application. And one woman described it this way when I sort of prompted her. I said, you know, you were lying. You were lying on a legal document. And she's like, well, I lie about my weight on my driver's license too. Right? I think there was just a lack of understanding of the implications of certain decisions and what that actually meant. Like, I don't think a lot of people, I'm sure there was fraud and there was fraudulent behavior on all sides, but I think a lot more of it was ignorance and optimism over the future that wasn't sort of considering the negative consequences. Okay, so what are the policy implications of this, just really quickly? One is the need to reevaluate the regulatory landscape, make sure that there aren't those cracks in the consumer protection net. This is what the Consumer Finance Protection Bureau is going to do, hopefully. I still think it's an interesting question, even beyond that. Like, let's say they've got it all figured out, they're going to solve it. One is that I think this kind of dual financial market exists for many more products than just mortgage products. And I think that understanding these dynamics is really important because I don't think it's going to go away with the CFPB and with the sort of understanding of the mortgage market. I also think it's really important to understand the difference between the institutions and protections and the product. I think there's going to be a shift towards getting rid of all kinds of exotic products, right? Getting rid of ARMs, I think there's going to be a lot of pressures to go back to sort of a simple 30-year fixed model. And I'm not sure that that's necessarily the right protective thing, right? So I want to sort of understand that better in terms of really understanding, was it the product themselves that was problematic, or was it that these institutions didn't do a good job of matching borrowers to products, and that matching function is what's important. I strongly believe in the need for, and I use affirmative credit financial system. I'm talking like affirmative action here. I don't think that leveling the playing field for mortgages and for other forms of consumer credit is actually enough. I think there's too much historical disadvantage embedded in housing and mortgage markets and in credit scores and sort of the difference in credits, that just evening the playing field is still going to exclude a large number of families from sort of equal access. And how do we remedy that? How do we get over that and actually sort of help these people on a path to opportunity? I don't know what it looks like, but I think this idea of local matters, and I want to use it for good rather than evil, right? Like the mortgage brokers figured out how to do this. Can we use social networks? Can we use these social norms to influence more positive behaviors and to support people in these types of big decisions as opposed to having it be harmful? And I think that we still need to think about how do we expand the supply of affordable homeownership opportunities? How do we build a better ladder from renting to homeownership that really supports families? This was an indication that people wanted to buy homes, right? People are still going to want to buy homes. How do we help them do that responsibly? And I think in a lot of cases it's trying to narrow the gap between incomes and housing affordability, particularly in homeownership. And in California, house prices have gone down, but still in my neighborhood, the average house price is $700,000, and median income hasn't changed since 2000. So there's still that gap between income and homeownership in certain areas. And then finally, homeownership programs shouldn't exist in isolation of other social supports. We see the role of unemployment. I think there needs to be, in some of the work that you guys are doing, sort of how do you sort of build a financial buffer to make sure that if people get stuck somehow, there's a way to support them so they don't lose their house as well. Next steps, unemployment, any ideas for isolating that? One thing that is still bothering me is the selection effects in terms of where people go, in terms of the mortgage market channel. Wondering if any of you guys have any ideas of what I might be able to use as an instrumental variable. Is there any way to really tease out whether or not African Americans and Latinos were steered into bad products? I haven't been able to successfully do that. And then I'm very interested in trying to understand geographic differences and trying to understand whether or not we want federal laws or we really want state laws, because there's enough variation among states that you want to have that type of local control and the ability to respond to local market conditions. So trying to balance a better understanding of that. That's it.
So it seems to me there's sort of two issues, both of them bad, right? So one, you could be sort of purchasing things you probably shouldn't purchase, but with an awareness of the price, right? So we see low-income people purchase too expensive of cars or fancy rims, and we think that those priorities are sort of wrong. But then there's the issue of sort of buying things without really realizing what the price is, right? So not understanding that your rate's going to adjust or something like that. Do you have a sense from your qualitative work how much of the first versus the second was going on? Because they have different sort of policy consequences, right? The second is easier to deal with, right? Disclosures or limiting financial products may deal with the fact that I'm tricked into not knowing that my rate's going to go from $1,200 a month to $2,000 a month. But the first is much harder to deal with.
So I found mostly the second than the first. But that doesn't mean that the seconds didn't also get into trouble because of some of that first process, in that they were making other purchasing decisions at the same time, right? I think we can't sort of see that mortgage product as in isolation from their credit card debt and the car they bought and all these other things that sort of other put stressor or financial stressors on the household. And a lot of them did have poor credit scores, which means that there's an underlying behavioral pattern that's not optimal in terms of how they're managing their finances. So, but I think, and here again with the qualitative, it's certainly selection too, right? These were people, even though some of them aren't in foreclosure, these are people who wanted to talk to me, which might be more likely to be in the second group than the first.
I'm wondering how many people thought of their homes as actually, instead of a place to live, as an investment?
So a lot of people, but not in quite that term. I think the idea was more, it's a place to live, but boy, did you see how much house prices have gone up. So more of that sort of mental investment than actual sort of, I'm going to sell it in 3 years and then I'm going to use that money to do something else. It was more the idea of being able to make that much money and not wanting to be left out of that.
So I sort of see two, I also have a division into two bad decisions. So I was thinking about it differently as, there's what to me seems a very obvious bad decision about, getting a 13% loan when you could have gotten a 5% loan or a 6% loan or 7% loan. And, that to me sort of, regardless of how you look at it, seems like an irrational economic decision. But this other decision about not really understanding the risk of what if the overall housing market in California goes down and housing prices drop by 40%? That it seems quite rational to me for people to assume that that wasn't going to happen. And so it seems, given that, then they're just getting a bad deal. It's not that they're sort of putting some larger stake at risk, or they're really risking foreclosure as much as they're risking, the fact that, okay, we're paying a little too much than we should here. And so, I'm not sure that people, certainly people didn't, but I'm not sure people really could have seen, foreseen the real consequences of making those bad decisions.
Yeah.
And so, putting the whole consequences on that person's decision rather than on the larger mortgage market seems a little unfair. And I'm not saying you're doing that.
No, but so what I would say is that I would put the blame on the lender, because the lender was underwriting those mortgage based on that house price appreciation, as opposed to the borrower's ability to repay at that instant, which is just good, credit underwriting. So I think the lenders were caught up in that same cycle, and that's where I see the problem, right?
But as you say, even some of these independent mortgage brokers were just the guy down the street.
That's
who
right.
Probably didn't have a whole lot greater understanding of the real consequences.
No, but then to me, then the policy solution is mortgage broker licensing, right, or some kind of required training or certification process, so that you do have informed people who are serving as these middlemen, as opposed to people who just really got their license in a week or an 8-hour session.
Agreed.
And I haven't seen much research that has looked at the effectiveness of different mortgage broker laws. But that's something that I'm sort of interested in to see if, and again, can we flip it? Can we turn it for good rather than for evil, right? Can we use those mortgage brokers as really informed neighborhood sites where people can get good information about different kind of lending products?
So the first part of the story you told is that today, people who are low-income and minorities have fared worse. And in the old regime of policy regulation, they went through a different channel. So they were able to get access to
They go through
different kinds of
any
loans,
channel.
through different kinds. So the new regime seems to be 20% down payment, no missed payment. So essentially there's no door. In which state of the world were low-income and minority people worse off?
As much as I hate to say it, probably the current world, right? Because, I mean, again, it's a timing thing. For a lot of low-income and minority families who got in 2002 or 2001, particularly in some of these markets, they did quite well. And still, even with these high rates, I mean, it's tragic, right? But it's 15% of African Americans. So that means that there's still 85% who are still homeowners and who might not have gotten in otherwise. I don't know. The consequences on neighborhoods, though, might tip the balance back to the, I can't quite.
Well, so that's the question. As a medical geographer, I thought you would have been looking more at, this seems to be the consequences for the individual families. What are really the consequences in neighborhoods where they have this density of foreclosures going on and bringing everything down with it?
Yeah.
Are you looking at that? Are you thinking about the policy implications on that?
So we're trying to do some of that at the very local level. And certainly trying to be involved with things like the neighborhood stabilization program and trying to think about other models for sort of helping these neighborhoods to respond. The problem is that there's no money for it, right? Like to turn this investment around, we're going to need lots and lots of money, and I don't know where it's going to come from. The other thing that's hard to unteach and then there is that a lot of these, not the Stockton so much, though they had their own sort of problems with sort of environmental sustainability and other sort of things about sort of building these big boom burbs on the outsides of things. But like West Oakland, a lot of these houses were in really poor quality even before the foreclosure crisis, right? These were disinvested neighborhoods even before the subprime crisis hit. So it's sort of harder to tease out how much of it is due to foreclosures and how much is due to sort of more historical patterns of disinvestment in these places.
I just actually wanted to ask sort of a clarifying question. You had said that the effects of the different doors that you could go through sort of disappeared in 2010. Is that what you said?
Mm-hmm.
And I'm just wondering, why you might think that was and what it might have to do with unemployment. And I'm just, in my head, kind of doing a little timeline. So bank bailout was in 2008, right? Fall of 2008. Dodd-Frank passed in 2010. Is there any chance that maybe banks and some of the regulatory stuff, they sort of preemptively did things because they knew that the financial regulatory bill was going to come?
No, so the loans were all made in 2005,
Okay.
right? So this is
Okay.
just looking at a 2005 cohort.
Okay.
But I think it's that the drivers of foreclosure today are different from what they were 3 years ago. And what we're seeing,
Like
what we're picking up now is more just overall economic distress. I think the other thing that we're seeing is, particularly given that we see high and middle income families now sort of exceeding low income families on the sort of foreclosure line.
Mm-hmm.
If you think about somebody who's lost their job, they might have 3 to 6 months savings to help pay their mortgage. We are in a period of unemployment that has the longest duration of unemployment, ever. And so if you're suddenly unemployed for 12 months or 14 months, even if you're a middle or upper income family, that might end up being too much to be able to support those mortgage payments. So we might be seeing people who, lost their job 3 years ago, but are now just at the point where they can no longer sustain their payments. I think the other thing that's happening is that we are seeing more strategic defaults, and we're seeing more people go into foreclosure due to the significant drop in house values. I mean, Arizona and Nevada both have seen 60% declines, or back at sort of pre-2000 levels in terms of house prices. So I think there's more people who are making that decision, which is influencing it.
I was just wondering, so if there's the world now that isn't necessarily great for low-income in the world in 2007, but is there, can you imagine a better world? Is there some way to better structure regulation so that we're not giving people crazy loans, but at the same time giving people more access?
Yeah, I mean, I think, and Michael can correct me if I'm wrong, but I actually think like the period from 1992 to 2002 was actually a period of expanded homeownership for low-income and minority households and good government programs that to support that transition. I think really what I think is if you want to sort of, we can go back to that, right? We can go back to sort of responsible and even low down payment lending. I think the trick is the whole securitization and the Wall Street sort of angle of this, right? There was just too much money flowing into this system and too many people making too much money. So I think you need to fix that piece and then sort of get to more equilibrium at the consumer side. And unfortunately, I don't know much about that piece. I think that that's a really opaque world, and I don't get it. Like, I understand households. I don't really get those Wall Street guys, and so I'm not sure what's needed there, but I think that that's where the solution has to start.
So it kind of went from Mike's world of 20% down or get out of here to people like Mel Oliver at the Ford Foundation who got awards for millions and millions and millions of dollars worth of mortgages that he pushed in North Carolina and the South by making homes affordable for minorities, particularly blacks. This all blowing up, and now you want to go back. I'd like to go back to a world you're in too, but how to get there is really
it's hard. And I think, I mean, HUD now is. I mean, I heard Raphael Bostic, who's Secretary for Policy Research and Development, and he's basically saying, you know, HUD's not into homeownership anymore. Like, I think right at the point where, but
they're doing terrible urban development too. What are they doing?
But the problem is that now, and I'm not sure I'm totally right about this, but now seems the time to support people to buying homes, right? Like, we are hopefully at the bottom of this market, and to say, okay, we're not going to do anything to support people getting into homes for the next 10 years until the pendulum swings again. Well, in 10 years, hopefully house prices have gone back up, and then all of a sudden we're sort of back in the same boat. It's like, let's fix the system now, because actually house prices are more affordable, and we could get people, and we could restore those neighborhoods by getting people into those homes. But I don't know if that's politically feasible at all.
Yes, you do.
Okay, well, we're just happen to be out of time. Carolina, thank you very much. I think we all